Hey there, I'm Dave Keller here with Market Misbehavior. Wanted to share with you today 3 key ratios that tell the story of the big picture trends at play in May 2023. So besides looking at the chart of the S&P 500 index, what else can we do to better understand the dynamics at work at any given moment in the markets? I use ratio analysis, which is the simple exercise of looking at one thing versus another. And I look at a whole series of ratio charts every day and every week to try to understand the relationships. What's outperforming? What is showing renewed strength? What is showing renewed weakness? What is starting to have an inflection point? What I wanted to do today is share with you the chart of the S&P 500 along with 3 key ratios that look at how stocks have performed relative to other asset classes, but also some information about signs of economic strength and maybe more weakness and strength that we can see from looking at the charts. Before we get to this chart of the 3 key ratios, if you like this sort of thinking about technical analysis, behavioral finance, and investor psychology, won't you subscribe to my channel? Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Which of these 3 ratios do you feel is most important and why? Let me know in the comments. Now let's look at the chart here. We have the S&P 500 at the top and then 3 ratios. We're going back over the last 3 years just to bring a good amount of history in here and really meant so we can look at the S&P 500, which is on a closing basis in the top panel. We can see the rally in the 2020 low, a little further off the left side of the chart, but you can see a nice uptrend in the second half of 2020 and it continued uptrend through pretty much the entirety of 2021. Look at how the market turned on a dime, how different 2021 was from 2022. The first 3 quarters of 2022, obviously pretty destructive. We made the new low in June, another what has now become the low for now in October of 2022, and now we've started a reverse course. So, simple exercise that Charles Dow taught us a long time ago. Look at the highs and the lows. Look how in 2021 we had a consistent pattern of higher highs and higher lows, meaning every time we rally, we make a new swing high for the most part. And when we pull back, we don't pull back any further below the previous swing low. That is the definition of an uptrend, right? Higher highs and higher lows. Look at how pretty much all of that changed in 2022 up to the October low. We go from higher lows to lower lows. We go from higher highs to lower highs. So we've seen this trend reverse from an uptrend to a downtrend. The new low in October 2022 put the S&P on a closing basis around 3,600. On an intraday basis, we got down to around 3,500 right at the low, but we'll call the low 3,600 just for simplicity. From there, look at how we've made higher lows in December, a higher low in March, and for now, we are still well above that March low. The highs overall were higher here in December, a higher high in February. Now we've stalled out. So now we're sort of in that question mark period, right? We're no longer making a higher high. As a matter of fact, until we get above this level on a closing basis, which means until the S&P closes above 4,200, we're no longer making higher highs by definition. You then would want to look at the lows. On an intraday basis, we got down to around 3,800. On a closing basis, it was around 3,850. So getting below the March low on a closing basis, which means if we would rotate lower and the S&P would close below 3,850, that would actually rotate lower. And Charles Dow would tell you we would now be in a confirmed downtrend. So that's what the chart of the S&P has looked like. Strong 2020 into 2021, weak 2022 into the October low. Nice rally from late October of last year to really February, March of this year. Now we're in this sideways trend, a question mark of sorts. The second panel down is looking at stocks versus bonds. We're not getting a great growth trend from equities. Should we go somewhere else? Go to bonds, for example. Not necessarily, because if you look at this ratio, this tells you the strength of stocks versus bonds. Look at how this chart has trended over the last 6 to 8 months. It's been sideways. So while the S&P has sort of stalled out, no longer going higher, bonds are not necessarily doing particularly well either. They're not breaking down, but they're not really going up either. Very similar to stocks. So they're sort of in a holding pattern as well. So basically, the market is indifferent, or as an investor, you should be indifferent as to whether you own stocks or bonds over the last 6 months. Basically, have had a wash, similar returns in either asset class. However, look at the difference between the two charts before the last 6 months. And there you can see the consistent outperformance off of the 2020 low, where stocks have consistently outperformed bonds. That's in 2021, which is a bull market for stocks. It was also in 2022, which was really a bear market for stocks, but stocks still outperformed bonds. And that's more relative or more dependent on the interest rate environment, right? Rates going up so much means bond returns are not particularly good. And so even though stocks were selling off, bonds were actually having a worse year. So overall, stocks and bonds have been about equal. So now stocks aren't particularly giving us great upside. Bonds aren't giving us great upside. Where else can we go? Enter precious metals. This is the ratio of the SPY versus the GLD, or stocks over gold. But I like to say paper versus rocks. Now, in rock, scissors, paper, paper covers rocks. And that happened through much of market history, particularly in 2020 to 2021. It was very much a paper over rocks or stocks over gold sort of environment. But look at how that changed again in the first quarter of 2022, when everything sort of evolved. The dollar all of a sudden starts to strengthen and stocks really start to underperform gold. You can see that actually was a pretty choppy trend for the first half of 2022. From about August, September of 2022 to where we're at now, the S&P has fairly consistently underperformed gold. That's because the S&P 500 has been going up a little bit. Gold has been going up a lot. There's a relatively small number of things that have done particularly well over the last 3 to 6 months. It's mega cap technology and communications names, the FANG stocks like Meta and Apple and Alphabet and Microsoft. It's things like semiconductors, NVIDIA and others, home builders, right? Gold and gold stocks would probably be the last one I would come up with, but some other random ones in there. But those are sort of some of the big important names. Maybe consumer staples I might throw in there as well, like Hershey, for example. But overall, it's a relatively small portion of the equity environment that has done very well. On average, gold has actually done much better than stocks, and you can tell that by the fact that the ratio has been trending downwards over the last 6 to 8 months. So as long as that trend keeps going down, as long as this ratio keeps making lower highs and lower lows, which it has been doing, that tells you that whether or not stocks are showing strength, gold has just been a better place to be. Here's the thing though, the bottom chart tells us a little more about maybe why gold has been doing so well, and it's looking at the ratio of base metals to precious metals. Now, what does this mean? The DBB is an ETF that tracks base metals. Think industrial metals, things like copper and aluminum. The DBP tracks precious metals, things like gold and silver and platinum. Think of the base metals as things that are functional, they're practical. You use them to build things like copper wires and metal and things that you would use to build a house or build a structure. Precious metals are things that just have value because people think they do. Things like gold and silver, well, they do have some uses. They're really more shiny metals that people like because they tend to be a good store of value over time. So the fact that this ratio was going up in 2020, 2021 into the beginning of 2022, the general narrative when you see that ratio going higher is that functional things are doing better than luxury or precious, less practical things. And that usually represents economic growth, right? When the economy is growing, we need more copper and more aluminum and more, things that help us build stuff and build cities and, create housing and all of those sorts of things. When the economy is struggling a little bit, then traditional stores of value, precious metals like gold and silver tend to do better. So look from the second quarter of 2022 really through this week in May of 2023, this ratio has been going lower. What that tends to indicate is that the economic conditions are worsening, right? Which is essentially what the Fed has been trying to do, slow down the economy. And when that happens, then precious metals, sort of those stores of growth, stores of value, tend to do better than practical goods because the economy is slowing, so we need less stuff to build stuff. So overall, we have the economic and market conditions in 4 simple data series. And again, there are other things, other nuances, of course, but I think this is a great chart to use to understand the relationships between these different asset classes, but also to focus on this chart to see if and when we would start to see some changes. So open question on each of these 4 items. Question 1 for the S&P 500, does the S&P finally close above 4,200? The NASDAQ composite, by the way, has already closed above its February high. It's sort of chopping around here as we end this week, potentially on a weaker note, but overall has already broken out. The S&P has not yet closed above 4,200. Until that happens, then this uptrend, by definition, Charles Dow's definition, has sort of stalled out. Here's the relative performance of stocks versus bonds. It's been sideways. So question number 2 on this chart, does either the stock side or the bond side start to show renewed strength? Do stocks outperform bonds, giving more of a risk-on feel to the market, showing you that stocks are really starting to perform better than a defensive asset class like fixed income? Does the ratio break lower, which would indicate more of a flight to safety, people selling out of stocks, maybe buying bonds as a defensive play? That ratio breaking down would be sort of most likely more of a negative sign for risk assets. Question 3, does gold continue to outperform stocks? Or to flip that over, do stocks continue to underperform gold, which has been a fairly consistent trend for the last 8 or 9 months? Finally, do we continue to see a downtrend in base metals versus precious metals, meaning this is a more defensive, economy shrinking type of trend? If and when that ratio turns higher, that most likely would indicate more of an alleviation of the recessionary concerns, inflationary concerns, and more to blue skies ahead for economic conditions and most likely for the markets as well. What do you think about these different ratios and what they tell us about the market? Which of these ratios do you think is the most important to watch and why? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Have a great one. Talk to you again soon.